Today, I am pleased to introduce Lee Ferridge from State Street. Lee serves as the Senior Managing Director and leads multi-asset strategy for State Street Global Markets in North America. With a background in macro strategy and prop trading spanning over 15 years, Lee and his team craft insights into foreign exchange, fixed income, and equity markets for State Street's diverse set of clientele, with a particular emphasis on leveraging their proprietary flow indicators. In addition, Lee is a frequent contributor to financial media outlets, and he is recognized for his commentary in both written and televised formats, along with his authored articles in various industry publications. Originally hailing from the UK, Mr. Ferridge joined State Street in 2008 and is now permanently based in Boston. Finally, he holds a BS in economics and business economics, along with a master's in quantitative finance, which is right up my alley. I'm excited to hear Lee's insights today, as the topics of Fed pivots, elections, and inflation continue to be top, I think, in all of our minds. So without further ado, please join me in welcoming Lee Ferridge.
My name's Lee Ferridge, as I said. I run the macro strategy team for State Street in Boston. What a great day to talk to you. All-time high in the stock market today. So a really good day. Don't worry, I'm going to burst that bubble of optimism over the next 45 minutes or so. I do have a reputation of being a pessimist. Look, I'm English, I'm an economist, and I live in Boston, right? It's a tough grouping. So today, the title of the presentation is putting the cart before the horse, which is an English expression. Apparently, some people know it, some don't. It means getting things in the wrong order. And the cart and the horse I'm talking about here, the cart is the whole disinflation, soft landing, here we go, everything is awesome. The horse is inflation, or the things that contribute to inflation. So it'll become clear as I go through, trust me. Let's have a look at the cart, where we are. So this is the market, what it's done over the last 18 months or so. Actually, less than that. But basically, rate cuts priced by the end of this year at various times since August of last year. What you'll notice from this is the market hasn't got a clue. Right? The market has been horribly wrong. The end of last year, sort of September, October last year, we had 2 cuts in, or maybe 3 for this year. By the time we got to January, we had somehow 7 cuts priced in for this year, and now we're back to 2. Market does not know what it's doing. But this bit here, this was all that soft landing narrative there, and we can look at it in a different way as well. So at State Street, we are lucky to have a lot of academic partnerships. We're in Boston, a lot of institutions there. So this is work we do with Ronnie Sadka, who's a professor at Boston College. And this is coming to something called MKT Media Stats. So what we do here, we look at hundreds of thousands of media articles a day, use natural language processing. We can see what themes the financial media is talking about. And I just use this one to highlight sort of this trend we've seen over the last 6 to 8 months or so. So what you can see is before, at the start of last year, everything was about recession and inflation. As we went through 23, particularly the second half of last year, that focus came down to replace by this mythical soft landing, whereby we can continue to grow, get inflation down, and we just, the Fed, Jay Powell is the greatest central banker in the history of the world. He's not, by the way. Look where we are now in terms of soft landing. Not so much anymore. And the fact is, even when we were at this point here of maximum optimism, 7 rate cuts, and everyone was sort of excited about the disinflation trend, there were inconvenient truths behind that. So the chart on your left, I'm rubbish at this because I'm facing the wrong way. On the left there, that just shows you that disinflation trend in the second half of last year. I've got core PCE, I've got core CPI. You can see how they came down quite impressively. That's what everyone decided the job was done. Inflation was beaten, we were ready for rate cuts. This is where we are now. looking at 3-month annualized inflation. Now, the green line you can see on here, this is Price Stats. This is another academic partnership. This was Alberto Cavallo at Harvard Business School. We scrape 10 million prices a day from the internet, and we can calculate daily measures of inflation for 23 different countries. This is the measure for the US. We get the data with a 2-day lag. So what you can see is Price Stats led the disinflation trend, and it's now going sideways. Here I'm looking at 3-month annualized or 90-day annualized for Price Stats. 90-day annualized Price Stats is at 6%. That's where the inflation rate has been over the last 3 months. If we look at core CPI that came out today, we're now at 4.6%, 3-month annualized. Core PCE is at 5%, 3-month annualized. You'll notice none of those are 2%, which is what the target is. In actual fact, what you can see is from the back end of last year, we're moving away from target, not towards it. And the truth is, even when we had the disinflation trend, it was very concentrated. In actual fact, it was concentrated in goods prices. So when Chair Powell back in 2021 talked about transitory, he wasn't entirely wrong because he was focusing on goods prices. At the time, goods inflation was at 13%, lockdowns, supply chains, et cetera, et cetera, et cetera. And that did prove transitory. Goods prices came down as the global economy reopened and everything got fixed. And goods prices now are negative. What Powell missed back then, what he's missing now, and what the market is missing now, is services inflation. Services inflation is not coming down. It is sticky. You can see here, that's the green bars year on year. Services inflation has not fallen for 6 months. It's stuck around 5%. I've also got average hourly earnings on there, which is wages. And the reason I put it on there is because the main driver of services inflation is wages. And you can see the relationship between the green line and the light blue line there. Because the biggest cost for service providers is wages. And they're not coming down. And I'll talk more about the labor market in a minute. Similar, that was CPI, similar story for PCE, exactly the same pattern, slightly lower levels, but the same story. The bottom line is, when you look at that services inflation, when you look at those earnings, the economy is too strong. We are growing above trend. We are growing at 3%. Trend growth is 1 3/4 estimated by the Fed, so we're close to double. But everyone keeps thinking we're going to see the slowdown. We got a weaker than expected retail sales this morning, mainly because of car prices, car sales, and everyone's suddenly excited. Or you've got the other people saying stagflation, which is ridiculous. But the underlying inflation is still the problem. So this chart here, this shows you supercore 3-month annualized. So this was the one about a year ago that the Fed started talking about supercore because inflation wasn't coming down as they expected. They blamed the housing market. Owner's equivalent rent, the shelter costs are about 44% of core CPI. There are quirks about how they calculate it. Fed decided they didn't like that because it wasn't fitting the story, so they invented this measure called supercore, which is core goods and services ex housing. And they said, this is the one we're targeting. This is the one that we can control with monetary policy. That's what we're focused on. 3-month annualized supercore is now 8.1%. The Fed aren't talking about supercore anymore because it doesn't work for them, because it's going the wrong way. And the bottom line is, with all of this, the economy is too strong, as I said. So this shows you the US Economic Surprise Index, the one done by Citibank. I stole it. It's on Bloomberg. I'm allowed. I don't credit them. Oh, I do credit them, actually. See, look at me. So this is the one that's Citibank. But what I've got is a 12-month moving average. Now, the whole point of the Economic Surprise Index is meant to mean revert. It sort of oscillates, a sine wave around zero. Because even if data stays strong, what happens is forecasters increase their estimates of the next data release. So it's no longer a surprise. That means you sort of move back towards zero, and eventually you go negative. But here I'm looking at the 12-month moving average. And aside from the reopening period, so when we're printing 3 million payrolls and data was all over the place, this is the strongest it's ever been. 20-year history of the surprise index, this is the strongest it's ever been. And that tells us two things. One, the economy is still strong. And two, everyone keeps forecasting a slowdown. Everyone keeps saying we're going to slow. Monetary policy is restrictive. We're going to slow down. And it's not happening. So then the question becomes, okay, so why isn't it happening? What does that mean for inflation? What are the areas of the economy we need to focus on? So this is where we get to the horses. And these are horses that upset the cart rather than the cart being in the horse, right? They're two mixed metaphors, I know that, but they both involve horses and carts, so I'm going to run with it. So the labour market, that's the first one. Look, I mentioned average hourly earnings before. They are coming down, but average hourly earnings year on year are at 3.9%. The move down is so slow, much slower than expected in terms of wages. We need average hourly earnings between 2.5% and 3% year on year to be consistent with the 2% inflation target. We are still way away from it. And at the pace of decline we're seeing now, it's going to take a long time to get there. But why, 2 years into a hiking cycle, rates at 5.5%, are wages so strong? Because we have a shortage of workers. So this chart here, the dark blue line here, this shows you the JOLTS to unemployed ratio. So JOLTS are the number of job openings in the economy, and it's divided by the number of people unemployed. We're at 1.35. Again, coming down, but slowly. And the fact is, if you look at this chart here, it goes back to 2000 when the JOLTS data started. The pre-pandemic peak for this series was 1.24. We're still above it. And 1.24, the labour market was hot, and I'll show you that in a minute as well. We're still above that at 1.35. The job openings in the economy are staying fairly flat, about 8.75 million. Number of unemployed is going down. It's really hard to get this number down. So why have we got this shortage of workers? Well, just to illustrate the shortage, you look at the chart on the left here. So this shows you US workforce. And what I've done, I've taken the 10-year trend prior to the pandemic and extrapolated out to where we are now. We should be at about 171 million people working right now. We're 168 million in the workforce. We are missing 3 million workers. So where did they go? They retired. It's as simple as that. The baby boomer generation, born between 1946 and 1964, is by far the biggest generation, and they are now at peak retirement years. So you see that here. So this shows you the change by age cohort from Jan 2020, so the month before the pandemic, to March of this year, sorry. So the overall US population over that 4 years and a couple of months has gone up by 8.5 million people. Within that 8.5 million, the over 65 part of the population has gone up by 5.5 million. By far the biggest of any age cohort you can see there, because the baby boomer generation are hitting 65 and they're retiring. Because of those 5.5 million, only around 500,000 are working. And that's not unusual. That's about right. That's about average. That's what people do when they get to 65, they retire. That's not some COVID influence thing. That's a pretty normal rate of retirement. The problem is that share of that is not the normal bit. So then people say, oh, well, the shortage of labor is about Gen Z. They don't want to work. They all want to be influencers. I'm looking at you, Kelly. They all want to be influencers and everything. They don't want to work. Absolute nonsense as well. Because when you look at this chart here, the light blue line, this is the participation rate of 25 to 54-year-olds, so peak working years. It's at the highest level since 2001. 22-year highs in the participation rate of those aged 25 to 54. Kelly's generation are working. Look, she's sitting here, listen to this rubbish. The most important line on that chart is the dark blue line, which is labor force as the share of population. It's declining rapidly. That's why we have a shortage of workers. Now, I said I'd go back to that JOLTS to unemployed. So here I've just drawn the line at 1. Look, you'll notice from 2000 when the data started to 2018, we were always below 1 on that ratio. There were always more people unemployed than there were job openings. Excess supply of labor. That's why there was no wage growth in that period. That's why we had very low inflation in that period, because you had no wage growth. People go, oh yeah, but that's post the financial crisis. No, the first 8 years of it were not post the financial crisis. That was a strong economy. We still had excess supply of labor in that period. 2018, it changed. Pre-pandemic, this started to happen because baby boomers started to hit that retirement age. So you saw that jolts to unemployed ratio went up. That's when we hit that all-time high of 1.24. Look what happened with average hourly earnings. When is the only Fed hiking cycle post-financial crisis before now? 2018. Because wage growth started to go up because you got those retirements and we got to that 1.24. We're at 1.35. Why are we talking about cutting rates? The labor market is tighter now than it was in 2018 when they were hiking. Horse number 2 is the housing market. Now, this might seem an odd one with, mortgage rates at 40-year highs, but I think housing market is going to have a strong year. You're going to see prices go up strongly this year. Why? Because we have an inventory problem. So this shows you units for sale. We have about 1 million across the economy. The peak post-GFC was 4 million, which you'd expect at that time. The average, pretty much the norm pre-GFC, was about 2 million. We're at 1. Why is there no supply? Because nobody wants to move. Nobody wants to sell their house. The average outstanding mortgage rate chart on the left is 4%. 50% of mortgages are 3% or less, 30-year fixed. If you move, you're going to get a mortgage of around 8%. Who wants to move? No one is selling their house because they're stuck between this gap here. So you have this lack of inventory because people have locked in 15 years of QE, financial repression, pushing down rates, everyone's termed out. So you end up with 90% of mortgages are 30-year fixed, and half of those are 3% or less. That's why no one's moving. But there is pent-up demand. We saw it at the end of last year when the Fed pivoted incorrectly and we saw long-end rates fall. You saw a surge in mortgage applications for purchase because there are people who want to get into the housing market. They've been sitting on the sidelines for 2-3 years. They want to get in. House prices are going up. So you saw, the weekly data on this mortgage purchases is strong. It's volatile, sorry. But in January, the 12-week moving average was at 3%. It's a 12-week average of 3% increase a week in applications for purchase. There is pent-up demand. Because the view is, well, if the Fed have stopped hiking, then, we're going to pay up for the mortgage now, but we'll refi in the future. We need to get into the housing market. But there's no supply. So inventory again against the Case-Shiller house price index. And Case-Shiller is on the right-hand side inverted. So as that light blue line goes down, house price inflation goes up. We're at 7.4% year on year. The bit in this chart that was wrong was that bit in 21-22, where house prices didn't go up despite the inventory because everyone's worried about COVID and higher rates. Now we're going to fill that gap. And this is why house prices are going to go up this year. Why does this matter? Because if inflation is going to get back to 2%, that shelter component of CPI has to come down. Shelter is 44% of core CPI. And, as I say, the Fed stripped that, did their super core, that's not working, and now every CPI print, even on this morning, it was like, did the shelter bit come down? No, it didn't. It was still 0.4 in the month. And the fact is, when you look at this, yes, there are problems with the way we calculate it, and it's got a lag and everything else. But look, pretty much CPI shelter component, PCE housing, they lag house prices by about 12 months. So the Case-Shiller bottom last May, we're now at 7.4% year on year. What you're going to see in the second half of the year is not that the shelter component comes down and helps CPI get to 2%. It's actually going to start going back up. That's what this chart is showing us. It's going to start going back up. That's going to push inflation away from target, not towards it. And this is why I think, look, unless we get 2 very low CPI prints in the next 2 months, and those come along with a distinct slowing in the economy, pretty sharp one, I don't think the Fed can cut rates in July. Okay? The market has the first cut priced in for September after this morning. If they don't move in July, they will not move in September. They're not going to make the first move of a rate cycle before an election like that. If they're already in a rate cutting or hiking cycle, the last meeting before the election, fine. But you don't start a new cycle 6 weeks out from an election, despite what Powell might say at his press conferences. They're not going to start then. So if July's out, September's out. The next meeting is November, actually the day after the election. By then, this is going to go the wrong way. So I think there's a greater than 50% chance the Fed don't cut at all this year. And less probability, but a very, very real risk, is they have to hike in 2025. Because if this is going the wrong way, and the labor market is still sticky and the economy is still strong, what else do you do? You have to start hiking again. I think that's a very real risk for the first half of next year. Now, the third market, and related to that, the third horse, is financial markets. The Fed like to go on about how financial conditions are tightening, and that's helping them to do the job of slowing the economy. Yeah, I'm not sure what they're looking at, because it's not their own indices. So this green line here is the Chicago Fed Index. Chicago Fed Index is showing that financial conditions now are looser than they were before they started hiking interest rates. If you use the New York Fed, so Chicago Fed last year was showing loose financial conditions. The Fed didn't like that because they wanted to cut rates. Powell is desperate to cut rates. I think there's political pressure. So they invented a new one. The New York Fed came up with the Financial Conditions Index, which when they came up with it, was showing financial conditions were much tighter than Chicago was saying. The problem the Fed have got now is the New York Fed Index is showing that financial conditions are looser than they were before they started hiking rates. And that is a problem, because if you have loose financial conditions, you have a massive wealth effect, which is what we've seen over the last 4 years. So this is change in US household real net worth since Q4 of 2019, so the quarter before the pandemic. So real net worth, I've deflated this by inflation. Real net worth has gone up by $33 trillion over the last 4 years or so. That is 28.5% in 4 years. Of that 33 trillion, 26 trillion is either equity markets or housing. We hit a new all-time high today, right? This is data up till Q4. That's the latest data the Fed have got. But the fact is that's going to be even higher because house prices have gone up since then, and obviously stock markets have gone up since then as well. Huge wealth effect. And guess where a lot of that wealth is? Baby boomers. They're retiring with portfolios that are much bigger than they expected to be. Not only that, because of where rates are, they can lock in a much higher level of income than they ever expected, be it in annuities or 30-year bonds or whatever. They're getting a much higher income than they expected. And this is where people say, oh, higher rates are actually boosting growth. Overall, no, they're not. Not all the rules of supply and demand and economics have been thrown out of the window. But it's a much more complicated relationship between the economy and rates than it used to be. Because people have termed out in terms of mortgages, corporates have termed out. They've all extended their credit out because that's what 15 years of financial repression does. They've termed out, and then you've got this element here. There are parts of the economy that we know are hurt by higher rates. Again, with the US, income inequality, we know lower earners who borrow on credit cards, they're getting hurt by it. Smaller corporates are getting hurt by it. We see that from the NFIB survey. So there's parts of the economy being hurt by higher rates, but not as widespread as it was. The US economy is much less interest rate sensitive than it used to be. That's why this is taking so long. And then you've got the structural element with the labor market. You've got this structural problem in the housing market. That's why we are where we are. Another thing to consider is the Fed balance sheet. It's still huge. It's still bloated. It's $7.5 trillion. It's 27% of GDP. If you look prior to the financial crisis, the Fed balance sheet stayed at 6% of GDP forever. It didn't move. As long as the economy went up, it went up a little bit, just stayed at 6%. Then we did the first round of QE, and then we did pandemic QE. It's still massively above the level it should be at, and they're now paring back QT. They're not going to be shrinking it as much. That plays into policy, and I'll show you that in a minute. The other thing we have to think about here is fiscal policy. We are running huge fiscal deficits, and we are set to continue to run huge fiscal deficits. So this shows you, this is Bloomberg consensus for annual fiscal deficits for the G7. Every other economy, they're going back to a deficit more normal, sort of 1% to 2% of GDP. US, expected to stay at 6% of GDP. And that's not just economists beating up on the US. The CBO, in their own forecasts, have the fiscal deficit over the next 10 years basically running at 6% of GDP every year. Now, for context, if you go from 1962 to 2022, 60 years, the fiscal deficit averaged 3% of GDP. We are saying over the next 10 years, it's going to be double that. The reason being that 3% of that is interest servicing costs. Because the debt is higher, the interest servicing costs are now half of the future deficit. The thing is with the CBO forecasts, they're too low. The deficit's going to be bigger because they're basing their forecasts on a neutral Fed funds rate of 2.5%. And it's not there, which I'll show you in a minute, I don't think. More context on this. So this is from the IMF. They published this last month. Their estimate of fiscal deficits for the next 10 years. If you add up their estimates of the US deficit for the next 10 years, it comes to about 80% of GDP. Now, that's not going to add 80% onto the debt level because you're using a fixed GDP number here. That will increase over time and reduce that impact. But I'm doing this for context. 80% of GDP deficit in the US over the next 10 years. The rest of the developed world, ex-US, 20%. Emerging markets, excluding China, 35%. US, 80%. That is, A, it's a massive problem going forward, and B, you have to factor that in when you're thinking about interest rates. So this is where we come back to, after everything I've said to you, I said I was going to kill that optimism about all-time highs, didn't I? Look, I could feel it in the room. Given everything I said, why are we talking about rate cuts? Because there is this view that rates are restrictive, right? And people get to that from looking at real rates. So this is the Fed's preferred measure of real rates, which is Fed funds minus core PCE year on year. Currently at 2.6%. The average over the last 15 years prior to now was minus 90 basis points for this real rate. So with 2.6 minus 90, with 3.5% above the long-term average or the 15-year average, conclusion is rates are restrictive. That is a massive recency bias. That is saying that this post-GFC economy is the normal US economy. You take this back further, same chart, but going back to 1971, the average for this real rate between 1990 and 2007 was 2.2%. The average from 1971, 2.8%. We're at 2.6. We're pretty much in the middle of it. Everyone assumes that that's the normal economy. It isn't. That's when you had peak excess supply of labor. That jolts to unemployed, remember, below 1. Not only that, but at that time, we had peak globalization. We had a huge domestic workforce because the baby boomers were in their prime working years, and we were sending jobs overseas. Now we've got a structural shortage of workers, and we've got nearshoring, friendshoring. We've also got greenflation. All of these things coming together, and we also have a much, much bigger fiscal deficit. And that's why that is not representative of the economy we have now. You could argue 1990 to 2007 is more representative. But again, you have to think about the Fed balance sheet, right? What does that do? Well, look at the same chart, but for 10-year realized real rates, so 10-year minus core PCE year on year. We're around 150 basis points now. Look at the post-GFC world, fairly average. Look at the longer term, right? So about 150 basis points now. The average for this 10-year real rate from 1990 to 2007 was 3.8%. You go back from 71 to 2007, it was 3.8%. That's the Fed balance sheet. That's what that has done. 10-year rates should be much higher now. So when we talk about policy being restrictive, people focus on interest rates, but interest rates are not all of policy. Policy is made up of the level of interest rates, the size of the Fed balance sheet, and fiscal policy. And those three things together, policy is not restrictive, and the data shows us that. If policy was restrictive, we would not be growing at nearly twice trend growth. We wouldn't be growing at 3%. If policy was restrictive, we should be growing below trend. We're not, we're growing above it. Rates might be above their neutral level, because I think neutral for Fed funds is probably 4 to 4.5%. So the Fed estimate is 2.625 nominal. That's what the long run dot is telling us. But a lot of people sort of think, oh, the Fed's view of neutral has always been around 2.5% nominal, so an R star of 50 basis points. When they first published their dots back in 2012, they estimated that neutral Fed funds was 4.25%. It came down over the next 7 years because of the lack of inflation. That's 7 years. Peak excess supply of labor, no real wage growth, peak globalization, normal fiscal deficits. That's not where real rates are. Real Fed funds neutral is 4 to 4.5%. That puts real neutral 10-year rates or neutral 10-year nominal rates probably around 6%, not where we are now. So rates are above neutral. Yeah, they are. Yeah, interest rates are above neutral right now. But policy is not restrictive because the balance sheet is too big and fiscal policy is too loose. So when you look at the whole lot together, the only bit of those three that's really going to change from here is rates. And this is why I come back to the risk is not of rate cuts. The risk actually is they might have to hike in the first half of next year. But really, all the talk about rate cuts here and the obsession with rate cuts, and we have 2 priced in for the year now, is misguided. Now, I've talked a lot about the US here. For those of you more international, a lot of these things I've talked about are very, very US specific. 30% fixed rate mortgages, for one, do not exist anywhere else in the world. So you look at, this is mortgage markets around the world, long-term fixed, you see the US, 90% of people are 30-year fixed. Everywhere else, much more of a mixture of short, medium, or variable rates. So short-term fixed is less than 3 years, medium is 5, all of these rolling off. This is why consumers in other places have been hurt a lot more than the US. Their economies are much more interest rate sensitive than the US because everyone hasn't turned out. Also, I showed you the fiscal policy chart. They're not running 6% deficits. They're not stimulating through fiscal policy. And that's why if you look from the second half of last year, this is consensus growth for last year, you see how the US accelerated away from the end of last year. Look at 2024 consensus growth estimates. The US is out on its own by a long way. So we now expect to grow 2.5% this year. Everyone else is below 1. The UK, that's why I left, below 0.5%. We are seeing the biggest economic divergence in G10 that we've seen for decades. You know, because for years, even in the 90s, all the economies used to move pretty much together. Now you have the US in a very, very different place from the rest of the world. And yet, when we look at interest rate markets, they still refuse to accept that. Interest rate markets still believe that all the central banks have to move together, led by the Fed. So you see this here. So this shows you, this is the year-to-date change in growth forecast for this year, the one I just showed you, but just the change. So we've added 1.1% onto US growth estimates for this year since the 1st of January. The others, apart from Canada, was a 0.4, but the others are pretty much flat or negative. On the y-axis, I've got the change in one-year rate expectations priced in by the market. So how much we'll cut in the next year? Well, actually, this is the change. So how many cuts have we taken out? We've taken about 90 basis points out of the US curve for the next 12 months. But we've taken 70 out for the Eurozone in the UK. Why? Why have we taken 3 cuts out of their curve when their growth is pretty anemic? Norway, we've taken out 80 basis points. You can see the others. You look at it another way. Here is just current GDP growth year on year, 3%, nothing. Rate change priced in 1 year, how many cuts we're going to get. The US is pretty much in line with the others. We might have one more cut priced in for the ECB than the Fed, but the others are all the same. Why? We're growing at twice trend rate. They're in recession. Why does everyone think the Fed and all the others will cut about the same over the next year? Because the market is used to all the central banks moving together. There is this misguided view that the other central banks wait for the Fed and then they can change rates. And it's interesting, the comments over the last couple of weeks from Madame Lagarde at the ECB. She said we are data dependent, not Fed dependent. Andrew Bailey of the Bank of England said that we are not looking at the Fed, we are concentrated on the UK. And yet the market still won't accept it. And the weird thing is, the only transmission mechanism between rate changes and domestic inflation, which they worry about, is through the exchange rate. Exchange rates aren't really moving, which I'll show you in a minute. So I think you're going to see much more interest rate divergence between the US and the rest of the world over the coming 12 months. It started to happen, but the market can price a lot more. And you'd say, even over the next 2 years, we're expected to cut the same pretty much as the UK, Canada, Eurozone, and New Zealand. Why? Makes no sense. So, what does it all mean? So, it's not positive, is it? Although in the near term, look, this is my view that I've given you. It's not the consensus view. As I said, we have 2 cuts priced in for this year. As long as the market believes that rate cuts are coming, then risky assets, equities, etc., can continue to perform well. That's what we've seen all year. We hit new all-time highs this morning. We're up about 10% for the year. And yet we've taken out rate cuts. We went from those 7 cuts to 2 cuts, but risk has rallied. Why? Because what we've done is extend and pretend. We haven't actually taken out the rate cutting cycle. We've just pushed back the start date. And as long as we can keep doing that, then equities can hold in. And we see it in our indicators. Talking about the yield curve first off, and then I'll get onto equities more. Look, I think the yield curve should steepen. If the Fed were to misguidedly cut rates this year, you will see the yield curve steepen, because I think that inflation will not be beaten. The long end of the yield curve will not like a rate cut, so you'll actually see the curve steepen up. And that's one way to play the view I've got now, is by being short duration. I think 10-year yield should be at 6%. So I would be short duration. Now, if they cut, long end yields go up. If they start hiking, they'll probably go up to start with as well. So short duration is a trade you can put on now. The equity trade, look, my view is pretty bearish for equities over the medium term. But as I said, in the short term, so long as the market can extend and pretend, then stocks can continue to go higher. And I think the market can extend and pretend into Q3. Right? I think it's going to be maybe August, maybe September. If that housing component starts moving up, that's when the market might actually have to sit back and go, are we right about these cuts? Is really the next move a cut? We had a wobble a couple of weeks ago when people started talking about hikes. Powell pushed it away. We've got the CPI today. Everyone thinks 0.3 is awesome. If we continue to print 0.3 on core CPI this year, we end the year at 3.9% inflation. 3.6 now, we'd end at 3.9. Target is 2. We'd be double it. They cannot be cutting rates. So, but for now, the market believes they can. And I think for the next couple of months, the market will continue to believe they can, and that means stocks can perform. And we see it in our indicators. So this is a very complicated looking thing. Is a measure of real money sentiment. So we are State Street, we're the biggest custodial bank in the world. We custody $40 trillion in assets, and from that, we produce daily measures of real money investor activity, what they're buying, what they're selling, how they're positioned. This is a measure of sentiment, looking across asset markets, looking at what they're buying, what they're selling in terms of a risk-on, risk-off perspective. It's neutral now. It's been neutral or positive for the last 65 days, which is what that chart there shows you. It's the longest run of non-negative sentiment readings since 2021. Real money are not euphoric investors right now, but they're positive. The background is okay. We can extend and pretend. It's not, it's not that they're say, overweight risky assets, because they're not. But they're fully invested. So that mentality can continue. We can see fresh all-time highs on stocks. We could probably make another 5% from here. But as we get into Q3, as we get to the middle of Q3, we get into the summer, I would be wary, because then I think if I'm right on inflation, the prints keep coming in, then the market might really have to start thinking about hikes. And once that happens, that's when the top is in the equity market. We're not there yet. Probably got another 5% to go. But second half of this year, from mid-Q3 onwards, I would be very wary. In terms of FX, look, everything I've said about US exceptionalism, everything else, it's hard for me not to like the dollar. And I do on a medium-term basis. On the short-term basis, I worry a bit about positioning. Real money investors positioned overweight the dollar. That's what these charts are showing you. That dark blue line is holdings of the dollar, excess holdings over and above normal. It's come off a bit. We're not as high as we were in 2022, October 2022, which was the biggest overweight in the dollar we'd seen in 10 years, which coincided with a big peak in the dollar. Sorry, that one over there. And you can see how our holdings measure tracks with the DXY dollar index. So they're overweight. But overall, they still like the dollar. Why wouldn't you? It gives you carry, right? You get the strongest economy, you get a central bank least likely to cut rates, and you get carry. And if things blow up, it's a safe haven as well. Why wouldn't you like the dollar in this environment? It's struggling to make much headway, but it will continue to outperform, particularly when the ECB cut in June. I think the Bank of England will cut in June. The Fed are going to be carrying on doing what we're doing now. And this shows you real money buying here, 20-day flows. Which dollars do you buy? I like carry. As I said, look, the next couple of months, risk is going to do well. Rate markets aren't going to move very much, so carry works. Dollar Swiss is the best one. I would be long of dollar Swiss now because Swiss rates are at 1.5%. We're at 5.5%. I get 4% carry. Dollar yen is another one, but complicated by the Bank of Japan. I get 5.5% carry in dollar yen. The thing is now the Bank of Japan are intervening, or rumored to intervene, not confirmed, but they did, pretty much. So it's complicated. The thing is with dollar yen, what you see, and you see the price action, it's going to be a case of going up the stairs, then coming down the elevator. So every day we're going to drift high, which is what we see, and then they'll come in and intervene, and it gets pushed down, and then it'll drift higher again and get pushed down. But they can't turn dollar yen around, given a negative carry of 5.5% by being long of dollar yen. I think we'll see dollar yen above 160. I think the next 6 months or so we could see 170 in dollar yen. And there's nothing the BOJ can do about it because you're seeing flow of money out of Japan to get higher interest rates elsewhere. And every day we just drift higher. And they can intervene and it'll be a choppy trade, but over the medium term, dollar yen's going higher. We are, though, stuck in a range, as I mentioned. You look at the 12-month range from the DXY. It's very, very narrow, hasn't moved for a while. I'm not looking for any fireworks in FX right now. Maybe in Q3, that's when we get a real movement in FX. Right now, we're sideways, pro-dollar, pro-carry. But when we come to Q3, if risk really does turn, that's when I want to be really overweight the dollar, because then you're going to get the safe haven bit will kick in as well as the carry you get with it as well. But if you're talking carry, really you're talking about emerging markets. Here you see FX vol, how low it is. Actually, emerging market FX volatility is lower than developed market volatility right now. So that's why when you look at the returns, people say FX doesn't move anymore. You can probably tell I'm an FX guy by background. You long a COPI over the last year against the dollar, you made 35%. If you'd long at MEX, you made 20-odd%. And this is against the dollar, not against the yen or the Swiss franc, which is what you actually would use to fund a carry trade. There's money to be made in EMFX. It's still there. Carry to vol ratios now are actually lower, actually higher than they were in July of last year, because even though you're seeing some rate cuts in central banks in emerging markets, volatility is lower. So your carry to vol risk-adjusted return is higher. You look at real rates, still very, very attractive. For the very brave, look, we like Brazil, we like Mexico, we like India. And if you're really brave, the best trade out there right now is long Turkey. 50% interest rates. Best performing currency this year. Long Turkey is the way to go, if you're brave and you don't mind not sleeping at night. And that's just positioning. That's just positioning using our data again in EM. There's still plenty of underweights in EM that you can move into. And that, you've got to read that now, legally. That's pretty much it, pretty much on time, and some time for questions if anybody has any. Yeah?
Why are gold and silver doing well this year?
There's too much liquidity. It's basically going back to that Fed balance sheet. There's excess liquidity. Bitcoin is the same story. Gold people will justify, but it's an inflation hedge, it's a deflation hedge, it's a this hedge or that hedge. It's liquidity. I think you are seeing certain central banks move out of the dollar and build their gold reserves, so that creates demand for gold. But overall, it's people searching for liquidity. I think that as long as there's excess liquidity, gold and silver will do well. And Bitcoin the same. And don't understand Bitcoin, wouldn't touch Bitcoin, but it goes up because of liquidity. Yeah.
When do we get a positive sloping yield curve?
If the Fed do squeeze a cut in, then we get it the day they squeeze the cut in, I think. If not, Look, I think 10-year yields are going to be higher. I'd be short duration. Do we get the steeper curve? Because if they hike, obviously the short-term yields are going to go up more than the long end. So you'd probably go more disinverted when they start hiking until they cut again. So look, if they mistakenly cut this year, it will disinvert this year. If they do what I say, it's probably going to be the back end of next year when we're in recession and they're cutting rates before you get it back up. Because I think we will have a recession in the second half of next year. I don't believe that we can get back to 2% inflation without a recession. I don't believe in the soft landing because we have to equate supply and demand in the labor market. And you only do that by reducing demand because supply is not going to go up. Now, one thing I didn't mention is immigration. People talk a lot about immigration. Look, yeah, huge amounts of immigration actually are needed. If you look at the labor force, I talked about the workforce. If you look at the growth in the workforce over that January 2020 to March 24, if you look at domestic-born workers, the workforce over that 4 years and 2 months grew by 314,000. That's 1 month's payrolls. Foreign-born workforce grew by 4 million. That's why the labor market is still growing. Without immigration, we wouldn't have seen any increase in the labor force. And we can argue about what type and this, that, and the other and everything else. But the fact of the matter is, developed markets around the world need immigration if you're not going to have structurally higher inflation and lower growth. Canada, last year, their immigration was 2.5% of their total population. Australia's got huge amounts of immigration. You're even seeing it in Europe, apart from one place, my hometown, the UK. The two places not sort of getting onto the immigration thing is the US and then the UK. So that is the one thing that is going to be crucial in the election, I think. And if we get an outcome that means that immigration doesn't happen, that's going to damage growth and raise inflation. Yeah.
What's the impact on corporate fixed income? I've heard a lot of talk around sort of the pig in the python, the debt wall, a lot of companies that might get out over their skis.
Yeah, this is where I come to the recession in the second half of next year, because if, as I said, if the Fed needs to raise rates in the first half of next year, which is, no, it's still not a central view for me. It's probably 35% probability, which is pretty high, I think, higher than anyone else. The second half of next year, that will bite. Look, as I said, there is still sensitivity to higher rates, credit card borrowings, lower income, smaller companies. That's why the NFIB survey has been weak, because they tend to borrow shorter term and more variable. That will all add up in the end. And then the second thing is what you're talking about is this credit wall, which really comes in size in the second half of next year. So corporates termed out, but that's the first really big credit wall we hit is the second half of next year. And that's why I think that's when we go into recession. And look, if we're going to get inflation back to 2%, we have to go into recession. The fact is, keeping 2% inflation target from here is going to be much, much harder with that structural change in the labour market. But that credit wall, I think, is what tips us into recession in the second half of next year. Yeah.
Sort of a corollary to that, would that also mean that corporate spreads blow out? I mean, part of the sort of thing now is like, well, would I buy corporate credit when I can buy a treasury at whatever? I mean,
that comes back to the same question about gold. That's liquidity, right? The fact that corporate spreads are so tight, everything is so tight, is excess liquidity. That would be when, look, we go to recession, you have a wall of credit, that's when they really blow out. That's basically it. But again, it's one of those where I would start, if the market really starts to price hikes in Q3, and that's the top in the equity market, that's going to be the bottom in those credit spreads as well. You'll see them start to widen out. But for a big move, it's probably the second half of next year when you get that wall, and if we go into recession at the same time. Yeah.
Does your view on the dollar strengthening and if we do get a rate hike next year, does that play into your view on any specific EM countries, if they're going to struggle versus the dollar, if they have a lot of dollar debt?
I mean, a lot of them have a lot of dollar debt. Look, the main worry in EM is China. And this is what, we hugely favor LATAM because they're tied to the US economy, they're commodity exporters, we have commodity prices going up because of the excess liquidity, so all of those things play into LATAM as the area you want to be in. The bit you don't want to be in is Asia because they're reliant on China. And Chinese growth is never going back to what it was. It just isn't. They're talking about demographics, their labor market peaked in 2015. They have a declining population. They have a hugely aging population. So they're not going to get back to that growth. They have a huge debt overhang. Think Japan, back in the early 90s, that's where China pretty much is now with the huge debt overhang. You had the overhang from the equity market then. That's where China is now. So that's the biggest concern out there is actually China in terms of EM. A lot of EM have been able to, because of 15 years of QE and financial repression, a lot of them have massively reduced their dollar debt. They've managed to issue in local currency. Investors wanted local currency debt because they got a yield. So you look at most of LATAM, it's all in local currency now. There's some dollar debt, but nowhere near what, apart from Argentina, but that's not all about Argentina. But most of them, their debt is in local currency because last 15 years, this is, the unintended consequences of QE. You've got, everyone terming out their mortgage, everyone terming out on corporate debt, and you've got this growth of local debt in EM. So the dollar debt thing, yes, it's an issue, but not as big as it was. But a stronger dollar doesn't help them, that's for sure. But China is a bigger concern, not from a dollar debt issue, just from a growth debt overhang and everything else. Yeah.
Will Bank of Japan entertain the idea of raising interest rate to manage the exchange rate?
I mean, look, they could. It's not going to make any difference. I mean, if they hiked by 25 basis points, so my negative carry is 5.25 rather than 5.5. I mean, it really doesn't change the equation at all. Look, I do think with Japan, I do think the inflation they're getting now is real. As opposed to the last 20 or 30 years. Because what Japan did with their demographics, they exported their shortage of workers because they hit their demographic problem in the early 90s when the rest of the world was awash with workers, particularly China. So, back in the late 1980s, there were 4,000 companies outside of Japan owned by Japanese companies. There are now 35,000, and they employ 50 million people. That's what Japan did with its demographics, but Japan was a manufacturing-based economy. We're not. Not only that, for the rest of the developed world now, which are not manufacturing-based, there isn't an excess supply of labor around the world. China's labor force is declining. So that's why Japan didn't get inflation with demographics. But going to the point now, their biggest demand for labor is in healthcare because their demographic problem has moved on 20 years from ours. So they're aged, our 80s and 90s. You've got a huge demand for healthcare. Japan does not have immigration. So this is where you've got a shortage of workers in Japan, and this is why their wage growth is real. So I think the Bank of Japan, over time, will start to normalize rates. Say normalize, maybe get up to 2% over the next few years, but they're going to be really slow to do it because they've had 30 years of deflation or very low inflation. They're going to be really reluctant and really slow to do it, and this is why my view on dollar yen. But I do think that over the next 2-3 years, you will see Japanese rates rise to more normal levels because I think their wage inflation is actually real because of the nature of the demand for labor. It's not manufacturing, it's healthcare. And that's going to be something that without immigration is going to push wages higher. Yeah.
What about your views on, given all this, the impact on various equity sectors in the U.S.? Which ones are the most hurt? Which ones is it sort of the normal playing field, or is it?
Well, I'm not an equity expert. I have people on my team who do that. But look, the mega cap tech stocks that have performed so well, and we all worry about their valuation. Look, they're a law unto themselves now. They're different from everyone else because not only is demand for their product, particularly the NVIDIAs and AI-related, pretty inelastic, they have massive cash piles. So higher for longer just means they're getting a better return on their cash. And this is what sets them apart from everyone else. So look, in a world of higher for longer, in a world where growth slows, they're still going to outperform because they're the ones who are still going to be printing positive earnings. The so-called value stocks and everyone else, if we go into recession, we got higher rates, there's going to be nothing to help them. So where we are now everyone wants to pull back on the mega cap because they've gone so far. No, I wouldn't be. I think they can continue to perform. The other one is healthcare. That, again, looking at the long term and everything else, if you're looking for long-term investment, healthcare is the place to go. So yeah, mega cap and healthcare is where I would be looking. And
Getting the most liquidity or has the most liquidity?
I'm sorry?
Whoever's receiving the most liquidity in terms of cash flows or has the most liquidity is sort of king.
Yeah, exactly. And because they've passed that point now where they're so cash rich that they've become their own sort of self-perpetuating entity in many ways. And they have such, such monopolistic standing as well that it's hard to say why would you not want to own them? Yeah.
Maybe a little bit taking the other side of that. Maybe share with us a little your views around the consumer. I'm thinking about with as they work through their pandemic savings, we're seeing credit delinquencies pick up. We saw retail sales fall today. Every company that I track is talking about slowing traffic. McDonald's talking about national value. And if they do implement more value strategies, it's going to coincide with increasing base effects. So the pressure on the consumer and the impact on the pricing environment seems significant. It's 2/3 of the economy, and some are saying that we could see a SOM rule trigger by Q4 in that scenario.
Yeah, SOM rule. a brilliant exercise in data mining. The consumer is, I mean, as I sort of touched upon and hinted at, you've got huge bifurcation in the consumer. You're right about delinquencies have gone up, credit card borrowings are at record highs, because those at the lower income level are struggling massively with what we've seen in terms of food inflation, energy inflation, and people talk about food prices aren't coming down. No, they're not going to come down. I mean, this is where they are. You're not going to get deflation. But in terms of their basket of goods that they buy, they've been punished a lot more than other people because food and energy is a much bigger share of their basket. And so people at the lower end of the income scale, yeah, they're struggling. They have been struggling for a while. That's why we're seeing, credit card borrowings go up. They also primarily don't own houses. They don't have stock portfolios. So yeah, the McDonald's of the world and those we've seen this from lower value retailers for some time now. But when you look at the aggregate, you've still got, that huge wealth effect. You've still got some, and pre-pandemic savings, there's a lot of speculation about whether they're gone or not. They're gone for a lot of people, but not everyone, right? So higher income have still got a lot of the money they had back then. So I think you've got, the question is for the economy, how far up to the income scale do we get that consumers are struggling? So at the moment, I think it's still fairly low, but it will creep up every day. The one sort of caveat to that is where you're seeing wage growth most strongly is in lower income, because those are the jobs where they're struggling to hire. So you're seeing the strongest wage growth in lower income. Real wage growth is actually positive, and that sort of helped. Delinquencies actually came back down a bit over the last few months because you're seeing real income start to rise. So you're right. And as I said all the way through, monetary policy still has an effect. It's just much less pronounced than it was, and it takes longer to come through. So yeah, you're going to see some retailers, particularly those who, they're to the lower income workers, they're going to continue to struggle, the McDonald's of this world and others. But then you're going to see others doing really, really well. So I think it's just a question of how far it creeps up that income spectrum. I think it's very low. High real income or positive real income growth helps to slow that progression as well. And this is where we get to, you need another jolt in order to really hurt the economy, and that comes next year. All right. 1:15? We good? All right. Thank you very much. Thank you.